Historically, investing has been an expensive pursuit for individuals. Whether paying high commissions to buy stocks and bonds through the brokerage operations of the past, or owning actively managed mutual funds and annuities with expense ratios of 3% or more per year, high costs created virtually insurmountable obstacles to individuals achieving the returns of broad investment markets. In a year when the Standard & Poor's 500 stock market index returned 10%, even if the professional manager was able to achieve a return of 11%, the 3% or more of fees and expenses borne by the investors would reduce their return to 8%, 2% less than the market return. This cost obstacle was dealt a crushing blow with the development of the index fund in the early 1970s. From an idea born in academia, a few idealistic trust departments, pension managers, and a small mutual fund company named Vanguard had the conviction that costs could be dramatically reduced for everyday individual investors. This idea put market-matching returns within reach. Now, 40 years later, index funds have become a model for low-cost investing and have benefited investors everywhere. Traditional index funds continue to provide a reliably low-cost way to invest. However, with advances in financial research and technology, they may not always be the best way to pursue low-cost market returns. An index fund has at least two types of costs. Explicit costs are simple to measure through the fund's expense ratio. All fund operations and administrative costs are paid from this. For an index fund today, total explicit costs may be less than 0.1% annually, quite a win over the 3 to 5% costs of the past. Implicit costs are a second category that academics and researchers are now considering. These are not as easy to quantify. Implicit costs within an index fund are related to the rules by which the fund is managed. Standard & Poor's and FTSE Russell are examples of firms who create indices that investment managers and mutual fund companies build funds to track. Most index creators update or reconstitute the securities listed in an index once or twice per year. On the reconstitution dates, index fund managers, due to their mandate to precisely track the index, are in effect forced to sell securities that no longer appear on the list, and they are forced to buy securities that are new to the list. As index funds get larger, there is the potential for market-moving impacts due to the amount of transactions on that reconstitution day. Imagine the world's largest portfolio being forced to entirely sell out of a stock in one day. Classic economics, the law of supply and demand, would suggest that for those stocks being sold, the oversupply would lower the price. In the same way, for those stocks being purchased, the extra demand would tend to drive up the price of those investments. Both price movements are implicit costs to the holders of the fund. Another potential implicit cost of an index fund is that of stale asset class exposure. On the date of index reconstitution, the Russell 2000 represents the smallest 2,000 of the largest 3,000 publicly traded U.S. stocks, according to FTSE Russell. However, 2 months later, some of those companies will have grown, moving into the largest 1,000 by current market value, and others may have fallen out. Investors who are intentionally targeting a portion of their portfolio to capture the small company or size premium want to be fully invested in the stocks that qualify as small every day. This is especially important as many return factors appear suddenly, and the investor must be well positioned to capture the return. Investors who want low-cost, consistent asset class exposure can get that today without having to accept the implicit costs related to supply and demand or stale securities lists. Technology platforms and real-time data enable fund managers and their investors to target asset classes at the lowest cost, allowing them to make small daily adjustments in their holdings. This avoids the single-day unfavorable supply and demand price impacts due to index reconstitution and related trading. This approach also allows managers to maintain daily fresh lists of securities that fit the desired asset class based on current market prices. Investors looking for low-cost investments should consider both explicit and implicit costs in their evaluation. Precisely tracking an index may not be the best way to capture the expected returns of asset classes within capital markets.